Good evening, ladies and gentlemen, and welcome to H World News. In a financial landscape that's been on a roller coaster since the onset of the pandemic, a recent Federal Reserve report reveals a concerning trend. Credit card debt has reached an all-time high in the third quarter of 2023. This surge, up nearly 5% from the previous quarter, isn't just a statistical blip, it's a red flag with potential ramifications for the broader U.S. economy. The data tells a story of consumers depleting the savings they diligently amassed during the pandemic's uncertainty. The average net worth of U.S. households skyrocketed by almost 40% between 2019 and 2022, a remarkable feat. However, the twist in the tale comes as inflation reached its zenith last summer, eroding these gains and leading to a significant drop in the average savings rate since 2022. Economists are sounding the alarm, pointing out that this isn't just a matter of shifting financial dynamics but potentially a harbinger of economic weakness. Mary Hansen, an economics professor at American University, suggests that the robust economic growth witnessed in recent months, driven in part by consumer spending, might be riding on a precarious foundation of credit card debt. The concern isn't just about the current state of affairs, it's about the sustainability of this financial strategy. The burden isn't evenly distributed. Low-income individuals find themselves caught in a financial squeeze, grappling with both elevated prices and the weight of high interest rates on their newfound reliance on credit cards. The report indicates a rise in delinquency rates on various consumer loans, including credit cards, auto loans, and student borrowing, particularly among this demographic. However, economists aren't unanimous in their assessment of the threat level. While some, like Mark Zandi of Moody's Analytics, emphasize the heightened financial stress on lower-income households, others, like Christian Weller of the University of Massachusetts at Boston, argue that the broader economy might weather this storm. Weller points to the robust consumption driven by upper and middle-income households, which still have more cash on hand. The question that looms large is whether the current reliance on credit card debt to sustain consumer spending is a temporary bridge over troubled waters or a sign of deeper economic vulnerabilities. As consumers navigate these uncertain financial seas, policymakers and economists alike will be closely watching to see if this wave of credit card debt is a passing tide or the precursor to a more significant economic storm. Remember to like and subscribe if you would like to hear more news stories like this.